Hello everybody, here's a quick visual of every bear this week. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks capped their best week of the year on Friday as the S&P 500 briefly hit 6,000 in change, and the market rally was spurred by Donald Trump's latest win of the White House as well as the Federal Reserve's rate cut yesterday. The stellar week of gains was just driven by optimism and sentiment that Donald Trump's policies will boost the economy, but not all stocks were feeling the same rush. Today we did see a bit of volatility in some of the bigger names: Nvidia, Microsoft, Apple, Amazon, Google, Meta, largely driven by what we saw here in the semiconductor names, and that's over uncertainty over Trump tariffs, what it's going to look like for these massive tech companies with large international diversified revenues, as well as China restrictions. But the rest of the market, everything from financials to industrials, staples, the consumer side, real estate, very, very green. What was also very green today was Tesla. It hit $1 trillion in market cap. Just a couple of weeks ago, the stock was trading at 240. Now it trades at 320. Absolutely wild move in this name. And it was up another 8% today, breaking the $1 trillion mark. Elon Musk's net worth is officially over $300 billion. You know you love to see it. Looking at Nvidia now, Nvidia was down 0.81% over China restrictions, but it was also down on the day it got added to the Dow. It replaced the chip giant Intel. And for those of you that actually hold the Dow, you now actually own a good portion of Nvidia in that index. And then looking at DJT, Trump Media and Technology Group, it was up more than 15% here today because Donald Trump said he would not sell his shares in the company. He is the biggest shareholder of DJT, and this is just great for overall sentiment. Still very, very volatile stock, a $6 billion stock that literally has 15 to 20% moves on the daily consistently. So not for the faint of hearted, definitely more of a ticker you trade than invest. But let's actually look at the broader market on the day, and the best performing sectors: XLU, XLRE, real estate, discretionary, staples, industrials, financials, sort of like the broader market really outperformed. And we saw a little bit of a rotation out of technology, out of communication services into the broader market, into every other sector, with the S&P 500 returning 0.4% for the day today. So despite what we saw in the XLK and the XLC, the rest of the market held up the overall S&P 500, and you love to see that. Now XLB, the material sector, was down 0.93%, the worst performing sector, and that had to do with the price action we saw in China. The market did not like the stimulus news. Even though China added stimulus, they were expecting more, and this is why we saw downside momentum in materials, obviously a name that's heavily levered towards China and their economy. And then looking at the broader market, we saw green across the board from value to growth, small to large. But today, the outperformers with small growth as well as mid-cap growth really taking the cake, up 1.23 and 1.37% respectively. And then all other factor and size segments were up from 0.1 all the way to as high as 0.55% and everything in between. Nonetheless, mid and small growth, this is where you want it to be today. And then looking at the week as a whole, guys, we had a stellar week. Every single sector was green. The S&P 500 returned 4.72% in the last 5 days. The Q's 5.46%, and the IWM, the best performing index and even beating every other S&P 500 sector, up 8.72%. For those of you that were positioned in small cap quality, your returns were roughly the same. Very, very strong momentum here today, and it all came after Donald Trump's win. You can see here Tuesday into Wednesday, that huge gap up, and price action actually continued to move higher even after that gap up. Very, very bullish price momentum. But excluding the major indices, XLY performed the best because it owns stuff like Tesla, up 7.5%, then the energy sector, industrial sector, and technology sector. These are all Trump heavy trades that will benefit. But, at the point where you're gaining 5% in a single week in the middle of the pack, it doesn't even really matter. It was a stellar week across the board. And if you were, no matter where you were positioned, you did really, really well in the market today. Even for those of you that were positioned into defensives for election volatility, you still came out with a week up 0.8% in stuff like XLP, the staples. However, looking globally, things weren't as bullish as it was in the US. We saw actually red across the board, except in Australasia. And this was mostly on the back of China's stimulus. China dropped their stimulus and there was massive disappointment over the new fiscal stimulus, which put pressure on Chinese stocks as well as oil stocks. The 1.4 trillion plan to refinance local government debt left investors unconvinced of its potential to spur a faltering economy. And as China goes, so too does Europe. And as Europe goes, we saw Canada follow suit as well as South America. So this put pressure on the broader global market. However, the US immune to that, and the US was very green, long and strong today. I know most of you are invested in US stocks, and it was a very solid week this week. And we saw breadth momentum did cool down from yesterday's highs. However, momentum still remains very strong in the short-term averages, medium-term averages, and long-term averages. And listen, a high percentage of stocks above their moving averages suggests investors are optimistic and bullish about the market's future, and is also an indicator of just solid market momentum, guys. And you don't want to fight this trend. Generally speaking, when we have this type of breadth thrust in the 3, 6, and 12 months after that, things are very, very positive. You don't get these breadth thrusts at market tops. It almost never happens. And this is a very great sign for what's to come in 2025. But let's hop on the charts. Hopping onto the charts, guys, we saw a very bullish day in all of equities. Equities as a whole just rallied today, except the NASDAQ 100, which was just flat on the day. The best performing index was the Russell 2000, up 0.74%. And we are seeing some very mixed price action in the after hours. Take it with a grain of salt, especially towards the end of the week here. What also supported price action somewhat today was the yields. The 10-year yield and the 30-year yield, the longer end was down 0.46, 1.24%, but the 2-year yield was up along with the dollar. So that did definitely impact markets to a certain degree. And we also saw that a stronger dollar weighed on commodities. Gold was down, silver was down, as well as crude, and Bitcoin was up. So very solid day in risk assets, especially equities and stocks in the smaller size, the mid-cap segment. And the S&P 500 looks very, very strong. Now we have a pattern forming here, guys. We can see that the gamma charts have not moved, and the S&P 500 is right at the top of the core resistance, meaning that asymmetrical downside is to be expected from these highs back to the gamma flip, unless we actually see a move up in the core resistance and the gamma flip. But I don't think we're going to get it in this OPEX week, but we'll see what Monday brings. We'll trade the plan. We are in positive gamma, but this generally does suggest we do see asymmetrical downside if we don't get a move up and we're at the top of the range. We're also at the top of the range for the NASDAQ 100 as well as the RTY, although the RTY has a little bit of room to run, but virtually at the top of the range, as you can see right there. All in all, this isn't a reason to get bearish. You're not supposed to take shorts when this happens. What you're supposed to do is really just hold what you have and wait for opportunities to get in. Maybe we do see a bit of a pullback to the gamma flip, but we could also just see the core resistance move to 6100, and then we continue buying dips, selling rips to that area. But we'll see what Monday brings. All in all, guys, when you look at this chart on a technical basis, things look very, very strong. And if we go to the US 500 up on the weekly chart, things also look very, very strong. That's the weekly candle close. That is just breadth momentum. That's a breadth thrust. When you look at it, that's a bullish candle, I believe a bullish engulfing candle, and you love to see it. And you love to see it on the weekly chart. Generally speaking, when you get candles like that, bullish engulfing candles, right, things tend to go higher. Look at this bullish engulfing candle right here. Look at this bullish engulfing candle right here. Look at this bullish engulfing candle right here. When we get these, yes, we can see a little bit of volatility and digestion. That can be the case. However, normally it does suggest market momentum is strong, and we typically do go higher. And I do think we see 6100 before the end of the year. Very solid price momentum, higher highs, higher lows, new all-time highs, and for the NASDAQ 100 as well. Very linear returns we're seeing at new all-time highs, but the Russell 2000 not at new all-time highs, guys, but very very, very close. We're about half a percentage point away from new all-time highs, and we should see it in the next couple of weeks. But out of all of the indices, the IWM saw the biggest breath thrust, up 8.73% for the week. Very, very solid. But let's go back on the daily chart and look at the overall gamma, and we can see that, yeah, we can actually see a little bit of upside maybe on Monday. However, if we do pull back, it would be normal, but we need to see if these gamma zones do move up for next week. I hate the fact that I don't get these immediately. These gamma flip zones adjust at the pre-market of the next day every single day. So, but you do have to understand we are in positive gamma. If the core resistance and gamma flip move up, we just buy dips, sell rips to those higher levels, and that means more upside price momentum. But I really do favor a little bit of digestion. I think it would be healthy if we actually just trade it a little bit sideways in all of these indices, maybe even down, and then go from there into the December time period. But there's a lot of tailwinds, especially stuff like buybacks, guys. The buyback blackout period officially is over for most of these companies, and we should see really strong momentum in stuff like the Nasdaq 100, which is really going to put a floor underneath stocks into the end of the year. And we also have these shortened trading days. So any pullbacks we do get between now and the end of November, that's a gift, and you want to buy those because we are going higher into December. I've been saying it all year. I've been saying it all quarter. Prepare for an end of year rally. And this is exactly what we're getting. We're getting this end of year rally. We are in the end of year rally. It's nearly the middle of November. We're done the first week in November, and stocks are rallying. This is the end of year rally we're seeing right now. I've been saying it for a while. I've been saying it all quarter. I've been saying it since August that do prepare for a Q4 rally. And had you positioned yourself here and here, and to be honest, I've been saying it for the most of the year, stocks will rally throughout this year into the fourth quarter. And that's exactly what we're seeing right now. This is a rally, guys. This is a rally. It's momentum. But let's digest some of these gains next week. Let's get past all the craziness and let's get through the inflation numbers, which are due next week. So all in all, you still want to be buyers of dips, buyers of pullbacks. Get into stocks that you like. I like Paycom, I like PayPal, I like Google, indices, I like Moat, I like the CARF index as well. I really do like this index. If you're looking for a high quality ETF, Moat is one of them. I also like CARF, okay? These are the individual names and ETFs you want to get into. But if you also just want to buy the RSP, if you also want to buy the S&P 500, go ahead and do that. They're great places to put your money. And yes, while they may appear overvalued on some metrics, I think when you actually take the S&P 500 and adjust for return on equity, market indices are actually a tad undervalued, at least according to my valuation measures. But they are subjective and not absolute return measures when you look at stuff like earnings and free cash flow, respectively. That being said, momentum is on the side of the bulls, and any dips we do get, buy those dips. And for those of you that are already positioned, you just want to hold because we are going higher into the end of the year. And guys, looking at sentiment, this is the fear and greed index. And right now, greed is driving the market, and what a difference a week can make, what a difference an election can make. Just 2 weeks ago, even less than 2 weeks, a week and a half ago, we were teetering on extreme greed and greed. We then moved all the way back into neutral, all the way back into the fear category. Then now we've moved back into the greed zone. Very volatile market, and just a whole bunch of optimism, euphoria, and pessimism in just a span of a week and a half. But this is where we are right now. You need bulls for a bull market, and we have them because greed is driving the market. But it's not just sentiment driving the market, it's also earnings. S&P 500 third quarter earnings has come in very good. Analysts were penciling 4 to 5% earnings for this quarter. Reported figures are for 8.2% earnings growth, 5.3% revenue growth, and we've seen a 7.5% upside surprise in S&P 500 earnings and a 1.7% revenue surprise, with 76% of S&P 500 companies reporting above analyst expectations. But with that all said and done, where do we actually go in terms of market momentum for the end of the year and for the rest of 2025? And normally what we see after an election is actually stocks tend to rally, but it's not as linear as this chart suggests. If we actually just get into the weeds, what we normally see is sideways price action for the first, I would say 15 to 20 days after the election. Then we put in a low, rally into the end of the year, and then the inauguration happens. At the inauguration, that's normally when the rally fades, and we do see downward price momentum for the first 90 to 100 days of the new presidency. Then then we put in a low sort of in the middle part of the year and then continue the rally onward and upward in the end of the year. So guys, we want to remain constructively bullish for the next 2 or so months. After the inauguration, that's when we could really start looking at material downside in the market. But as it is right now, I just don't see that. And history tells us that we are likely to see further upside even after the spectacular rally that we've had so far this year. And what could really support this rally is stuff like margin debt. If we look at FINRA margin debt versus the S&P 500, in every bull market peak, we saw FINRA debt significantly peak above the S&P 500. This is simply not the case at the moment, telling us that there's still gas left in the tank, a lot of gas left in the tank. And for those that's claiming it's a bubble, it's not. There's plenty of liquidity when it comes to margin, when it comes to cash on the sidelines. And also, hedge fund gross leverage declined ahead of the election, meaning there's further gas in the tank, especially from hedge funds and institutional investors if they decide to turn that on. And also, US corporates record buyback authorizations is a tailwind for this market. Considering the estimates for the end of the year, this means that US corporates have to effectively buy back $6 billion worth of stock into the end of the year every single day. That's a huge tailwind for the market. That's a bid under the market. And all of these things together should further propel the market to new cycle highs into the end of the year. I'm talking about seasonality, margin debt, hedge fund, corporations, buybacks. All of this is just a tailwind for us to go higher. And then in the new year, we can talk about material downside. Also supporting equities and the longer term rally of equities is the macro environment, the economy. GDP growth, economic expansion remains robust at 2.66% according to the weekly economic index here by the Dallas Fed. That's robust growth, and the consumer also looking very, very strong. Costco, a barometer I like to use, saw October sales increase year over year 7.2% in total, and this bodes really, really well for the consumer. If you actually look at excluding impacts from gasoline and foreign exchange, so pretty much effects and gasoline neutral, you can see the US was up 5.8%, Canada up 8.7%, total international market was up 8.4%. So the middle class upper end consumer who shops at Costco looking very, very strong right now. Further adding on to this, not just looking at Costco, but looking at the broader consumer, the US Redbook Index is near cycle highs. We saw an increase of 6.1% year over year in the Redbook Index yesterday. Very, very strong. You love to see that. And consumers right now are seeing a ton of buying power, spending power on the back of wages and lower inflation. And what's also helping the consumer is rate cuts. We got a 25 basis point worth of a rate cut yesterday, and the market thinks we will actually see further rate cuts in December. The market is pricing in a 72% probability of a 25 basis point rate cut. And again, this just goes to the consumer, and this is starting to unlock certain parts of the economy, stuff like the IPO market, M&A, residential fixed investment. All of this is going to be very supportive for equities as we get rate cuts into 2024, and not just equities, the consumer, the economy, and everything in between. And now we've just had a crazy week of earnings, data, the election, FOMC, and next week it's going to be a lot more calm, although there's still going to be volatility because we do have some big names reporting, particularly some Chinese names. Alibaba's reporting earnings, as well as JD, and a couple of China related names. For example, AMAT has some huge China exposure, and same with a couple of other companies, but less so in market cap size. Apart from the Chinese names, we also have Home Depot reporting, Cisco, Disney, Shopify, Brookfield Corporation, Spotify, NU, Sea Limited, and a whole range of other companies, guys. So we can definitely see volatility in some of the software names, some of the Chinese names, and even some of the staple and consumer discretionary names with Home Depot. And then looking at data next week, a calm week compared to this week, but what everybody's going to be focused on is CPI. We get core inflation as well as PPI, and then we also get a Jerome Powell speech on Thursday. So everything really kicks off Wednesday next week into Thursday, and then Friday we also get retail sales. So a very data heavy heavy week as well as an earnings heavy week, nowhere near what we saw this week in data and last week in earnings. So a fairly light week, relatively speaking. That being said, still prepare for fireworks and subscribe to this channel so you don't miss a beat. And guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm.